Hey everybody, good to be here today. My name is Brent Moores, and today I want to talk about something that confronts every option trader at some point. You know, a trade has gone against you, and short of just closing it out or just accepting the loss, what do you do? Is the question. Can we fix a trade? Can we adjust it somehow? Yeah, well, let's take a look at that. We'll explore that a little bit more in detail here. And so, I welcome you out. As you have questions, feel free to type those in the chat if you're watching live. I have in the chat if you're watching live. I have Mike Fairborn helping me out today. So between Mike and myself, we'll do our best to help you out. You can follow us on X at BrentMooreCS, at Mike Fairborn CS for additional content as well. And before we get to the main stuff here, let me just mention a few things. One, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation of any security strategy or chart type. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is for educational purposes only. All investing involves risk, including risk of loss. Past performance of any security or strategy does not guarantee future results or success. And the paper money application will not assign a short option early. That can certainly happen in real life. So just be aware of that difference. I'm not going to factor in commissions in most of our examples here today. So just realize that, and there's something you can consider. So let's do this. What I want to do is I want to look at, so we have an existing portfolio here, and some trades are going, wonderful, and some are not going so wonderful. And so today I want to talk to you about, modifying existing trades, and then I want to look at, depending on time, some existing positions and discuss the management of those. But really, the main thing I'm talking about is managing an options portfolio, managing something that maybe isn't going so hot here. So let me start off with this. Let's look. I'm going to look at not that. We're going to look at. I want to start off with Morgan Stanley here, and we actually did a trade here on Morgan Stanley. It's a long vertical spread. You can see Morgan Stanley right here, and it's not going well. We're down money on this. What kind of trade was this? This trade was a long call vertical, a 132, 140 long call vertical. Okay, when did we get in this? We got in this on the 12th. Okay, let's just take a look. What's it done? Long call vertical is a bullish trade. The 12th was here. We were expecting a bounce here on this, and initially it actually worked out pretty well, but it just went south on us. And so it's in a hole. This is a 132, 140 long call vertical. And so what I'm going to do here is I want to just kind of mention this. I want to talk to you about what our kind of our max gain, max loss was getting in this trade. So let's pull this up here. So it's a long call vertical. I'll just put LCV. I'm going to make this a little bit bigger so you can see that a little bit better. There we go, long call vertical. And it's a 132, 140. How much did we pay for this trade? This is a debit spread, so it costs us money up front. Well, what we can do is we can go back to our monitor tab. We can go to our account statement. I'm going to pull up Morgan Stanley here. We're going to look back, and it was a 462 debit. So when we enter this trade, the max loss on this is our initial debit, 462 debit, and that's our max loss. Okay, max loss. And what's our max gain on this? Well, it's going to be the difference in the spread. That's $8, the difference between 140 and 132, minus our max gain. And so that is, I'll put, just to be consistent, I'll put a decimal point there. And for our max gain is going to be the difference between 8 and 462, which is going to be 3.38. That's our max theoretical gain, okay? These are all theoretical here. Because keep in mind, you can be assigned early on these trades, and then you end up with shares or you're short or something, and things can change. But that's the initial structure of the trade that we got in this trade. That's something you need to be careful about when we start. But this trade has gone against us. We're going to be staring before too long this max loss in the face here on this. Let me just move this out of the way. Let me go back here and see we're down $243 on this right now. So we're halfway to our max loss. Can we change this trade? Can we shift this trade? Can we fix it, so to speak? And here's something I want to talk about today in terms of fixing trades. You may hear this fixing. Well, it kind of depends on what you mean by fixing, but any adjustment you make on a trade brings on new risks or complications with that trade. And if you're looking to adjust a trade and you don't see those, then you're not understanding it well enough. So it may be that you still do it, but that's a choice, knowing the risks at hand. So let's say we did this. Let's think of a couple possible modifications on this trade. Instead of this 132, 140 long call vertical, what if we shifted this from a 132, 140 to a 132, we'll say 134 long call vertical. So I'm going to keep it in the long call vertical realm. I'm going to keep it bullish, but what I'm going to do is I'm going to shift this. I'm going to, oops, let me get rid of that. I'm going to shift this, and I'm going to take this 140 call, which right now is not worth much. That's a short contract, so I'm going to buy that back. It's not going to cost me much to buy back. That's a good thing. Doesn't cost us much to buy it back. Okay. And what I'm going to do is I'm going to sell a 134. And if I sell that 134, what are we going to do? Well, that's going to presumably we'll be able to sell that for a lot more than we buy this one back for. So that all sounds good at this point here, but there'll be consequences on this as well. But I want to think about this as we talk about modifications. So we're going to go to Morgan Stanley here. I'm going to go to March 7th because that's our date. And we're looking at this 140. If I buy this back, it's going to cost me roughly $25 to buy back. If I now turn around and sell this at 134, we'll be able to sell that for about a 150. That's going to be a net of $125 or something like that. Okay, that's a credit we're bringing in. Remember, we had a debit to start this trade. So let's look at that. So our initial debit was 462, and we said, and that's our max loss. We're not going to be shifting our max theoretical loss here by bringing in that 125, but that's going to reduce that 462. If I take 462, subtract 125 from that, that kind of is limiting our loss to $337. Now, there's consequences though. Okay, so what are the consequences if we do this? Number one, okay, we reduce the debit. I just discussed that. We reduce the debit. That's a good thing, right? That's a wonderful thing. Two, and thus we're reducing the max loss. But the big thing here is we're reducing the potential gain. Because remember, on this is a long call vertical. Our gain depends, the amount we make depends on how far this spread is. And if this goes up to the upper strike, that's in great shape. But if our upper strike is down to the, say, a 134 level, okay, then we're cutting into the max gain on this trade significantly on this. So let's let's think of that if we were to do this. So let's look at the trade here. So what I'm going to look to do is I'm going to look to roll. Now remember, when you roll, you're not saving commissions. You still have commissions there, but I'm going to look to roll this just from a 140 to a 134. I'm going to right click, create a rolling order. I'm just going to click on that. And I'm going to keep the same month here. And it doesn't like that. It's going to say you have the same strikes. Well, I'm going to shift that strike. We're going to shift this to 134. So I can roll this right here. And there's my credit. You have a hard time seeing that. I don't know if that'll show or not. 131 is the credit we're bringing in to help reduce the loss on this. And so that would be wonderful. But you have to ask yourself, look at this trade. Are we still bullish on this trade? What are your thoughts on this? From a technical analysis standpoint, what I would say is, at this point, we have a significant support level, which we broke. It went down there. That's now a potential resistance. We actually went below our 50-day moving average. That's probably kind of a potential resistance here as well. And while we may not be super bearish on this, maybe it's overextended itself a little bit, it's not looking like the same trade that we got into as an example bullish trade before. Now, if you're still bullish on this, maybe you leave it as is, maybe you consider the roll we just did, but just remember the consequences of the roll. We're reducing the debit, we're also reducing that potential gain there. Okay, that's the consequences of doing that proposed roll. There's another way we could do it as well, though, and that is, instead of saying we're going to shift this from a let me change my color here just so you can see it a little bit better. Instead of shifting this from a 132, 140, down to a 132, 134 long call vertical, what if we did this? What if we kept our long call at 132, and instead of shifting this down to 134, what if we shifted it all the way down to 130? What has changed in this trade at this point? These are both calls. It was a long call vertical. It is now, if we were to do that, we would then have shifted this to a short call vertical. This was a bullish trade. Even with the modification, it was a bullish trade. This would now, with this proposed change, would turn this into a bearish trade. By buying back the 140 and selling the 130, we'd bring in an even bigger credit than we would than if we shifted it to the 134. Let's just see how big that's going to be. Let me get out of this and move this out of the way. So let's do this same thing, but instead of going 140 down to 134, I'm going to make this a 130. That brings in a $355 credit, 355 credit. Let's go back to our initial trade. If I were to shift this to a 132, 130 short call vertical, what are the consequences? One, we're going to significantly reduce the initial debit. Okay. So that initial debit was 462. That's the loss here. Minus 358. So essentially, we're reducing that initial debit to about $100. Okay, it's not technically initial debit anymore, but we're reducing that by $100, we've turned it bearish. Okay, that's the second thing. The best case is it expires worthless. Expires worthless. What do I mean by that? What I mean by that is this, is if both of these expire out of the money, then we won't have to do anything to spend any money to get out of this trade. You got that? That's the best case scenario at this point. But do you see the problem? We said we significantly reduced that debit, but we're essentially locking in a loss. Okay. Now that loss is less than the loss we're going to be at right now, but we're locking in the loss here at this point. And if the stock bounces at this point, then the loss could actually increase from here. So there's kind of different choices you have on this. And there's no more upside, well, I guess would be the next thing. No more upside potential if we do this. So in terms of managing this trade, let's think of things we can do. One, we can let it sit tight. Okay, we're going to just let it sit. That's one possibility. Hopefully it turns bullish on this and we keep the full potential. Two, we could just exit right now. Okay, we could exit right now. We're going to realize the loss if we were to do that, which is okay. It was, I can't remember, it was about $220, $230 loss, I think. We could exit, realize the loss, and sometimes you just got to accept your losses there. Okay? And there's some good questions coming in. I'll get to those in just one sec. Another thing is we can roll down to in this example, I said we could roll down to a 132, 134 long call vertical, still bullish, reduce the potential upside, but also reduce the loss that we have, the potential loss. That's a possibility. Or we could roll this down to a 132, a 130, 132 short call vertical, okay? And that, we're reducing the debit, we're turning the trade fundamentally into a bearish trade. There are four choices for you, and of course, you could tweak the different strike prices that I put there and still get the same effect on those. What's the best case? There isn't a best case scenario because I don't know. You'd have to know what the future is. Obviously, if this just turned bearish, the best situation would be to do option number 4 there. If this turns significantly bullish, the best case is number 1, sit where we're at. If it's gonna stay basically where we're at, then we're down to these two choices here, and there's not maybe a huge difference on that. Now let me address some questions. Harry said, can you be long and short on an identical option? The answer is no, Harry. You cannot be long and short on the identical option. That's why when I tried to roll that, did you see that initial message when it was looking to get out, not to get out, it was looking to buy back the same one I was looking to be, I'm trying to remember the situation. I was looking to be short the exact same I was long. You can't be both long and short the exact same contract at the same time. And so what it does is it just shuts you out. It just closes you out of an existing contract. So, +1 and a -1, add those together, you end up with 0. Okay, other question. And actually, let me get to, Kevin, I'm going to get to your question in this. in one sec, but Alexis said there's a fifth option that you haven't mentioned, and that is you can extend the timeout. Absolutely, you can extend the timeout. But if you extend the timeout, remember, there's pros and cons to everything you do. It is going to cost you more to, if we just take this existing 132, let me get out of this screen here. I think that's worth bringing up, and I'm grateful that you mentioned that, Alex. What if we just, let me delete this. I'm going to go here and let's look to roll this whole thing out. I'm going to create a rolling order, and I'm going to do this. I'm going to do this whole guy out, and I'm going to go, we'll go out a couple weeks. Say we feel a couple more weeks is going to give us the time that we need for this thing to ultimately turn bullish. Remember, this is a bullish trade. Extending it out in time doesn't change the characteristics of it. This is a trade where we want the stock ideally to go above that 140 level. By extending it out, we're just giving it more time to do so. This trade right here would get out of our existing and roll it out in time here. But what's the consequence on that? The consequence is we've just added $81 plus commissions to our initial debit there. Is that worth it? Maybe. If you're bullish and you think it's just going to take more time, that may be worth it. Is there a downside? Yes, there's a downside. There are no free lunches, folks. And the initial debit, which we said was, I can't remember what it was, 460 or something like that. You'd have to add 80 cents to that on that. So yes, would you ever do that? Yes, you would do that if you felt that you're still bullish on this, but you just need more time. That's not the approach we're going to take today on this. And but I want to just show you, you'll hear sometimes people talk about fixing trades. With every scenario we went through, the fix possibly helped, but it also added on some risk there. Now, the question from Kevin was, how does days till expiration factor on this? There's only 10 days till expiration. Yeah, that's a reasonable observation there, Kevin. There are only 10 days to expiration. And if my goal here is for this to end up above 140, this was a little bit more of an aggressive trade. It's not like our out of the money options, out of the money short verticals we often do. We were hoping this to go up significantly. We only have 10 days for this guy to go up that much. That's a pretty big haul on this. And so, yeah, that does certainly affect the trade there. Kevin, I'm glad you asked that. And so normally on these trades, we're looking to get out with about 10 days to go in, or, on almost most of these trades we go over week to week in this class. We say we're going to have a time exit when we get under 10 days to go to expiration. We're going to get out of that. Then, yeah, we're right. Well, we're at 9 days till expiration. For our purposes today, I'm just going to look to exit this trade. Okay. So I'm going to right click on this. I'm going to create a closing order. I'm going to sell this just to get out of it. We're going to sell it. Our initial debit was 4 something. We're recovering half of that approximately here, which is, that's the kind of take a small loss and live to trade another day type scenario here. Let me just put this in, and I'm going to confirm and send this, and we're going to send that. Take our lumps, so to speak here. It's thinking, we'll see if that fills. I don't know if it will. We can always tweak this a little bit later. One challenge, though, when you're modifying trades is this. I want to point this one out because we actually have 2 kind of big losers here that I want to look at. And then we have a couple that are a little bit more iffy. This is another long another long vertical. This is a long put vertical. But what I wanted to show you on this one is, we could potentially modify this. But there is a challenge when we start to look at these contracts. Let's look at Colgate. Here's our contracts, okay? Do you see a problem on this one right now? This is a short option. It's actually shifted from where I looked at this before the session, and it was showing this, and it was showing 0.75. It's shifted, and it may shift more as we're talking, I don't know. But that's the liquidity issue that we often talk about in this class. Sometimes when you are looking at trades and they're at the money, stock's at $90, you see this and you go, oh, that's not too bad. Or you look at the open interest and you go, it's not too bad. But when something goes significantly out of the money, it becomes much less liquid here on this. It becomes much less liquid, and it becomes a challenge. It becomes a challenge when you're trying to manage these trades. So I can look to buy this one back, and it's kind of nice because it's cheap. That's a good thing, 15 cents. Earlier, it was showing 75 cents. But it may not fill. In fact, it seems like even on that Morgan Stanley trade, which we put in this order for, it seems like it's having a little bit difficulty filling, even though it's a much more liquid contract. I'm going to go right at that natural price or so and see if we can get that to fill. There we go. That did fill this time. So liquidity becomes an issue when these trades come against us. All right, let me just double check questions, and then I want to talk about short verticals as well on this. John said, it's hard for me to take a loss, and I feel even worse when I get out and then the options turn around. Amen, brother. That is absolutely true. Because look what's happened. We just got out of this. We took a loss to try and save ourselves from a bigger loss. And that's kind of an operating principle we often use in this class. But in 3 days, when the stock is up here, we're going to be going, oh my goodness, especially, that's a paper money trade, but in real money, that's hundreds of dollars. There's a certain skill, folks, certain, mindset that you kind of don't need to, you need to just kind of forget about past trades is my take on that. So let's take a look though. Let's shift here, different types of trades. Let's go to short verticals. And I want to look at GM. GM, we're not actually in a losing position. We're basically even on this, okay? In the chat, Paul said, cut losers fast. That's what we did. That's what we tried to do. We were a little slow, probably could have cut it a couple days ago, but sometimes I do want to show these trades in this class. And I know this is something I've been wanting to talk about for a little while. So sometimes we'll hold on to things a little bit longer than we would have to make it to this class. Although sometimes that works to our advantage too. So we're basically kind of break even-ish on GM, up just a smidge right now on this. But let's see what we got. We have a short call vertical. And by the way, everything I'm saying on call verticals can be true on put verticals. Same thing here. And 50.51. Okay, so this is short call vertical. We want it to stay below $50. Right, we're kind of cutting it a little bit close here, 49.30. Let's look at the trade. We're bearish on GM. Let's see what GM looks like here. And it was looking kind of bearish, and today hasn't helped the cause. GM's up $5 today. Not $5, 5.5% today. 2.5 bucks today. So this trade, which actually was doing pretty well, we're kind of borderline on this. Let's think about the initial situation on this trade. The initial situation is, let's go and just take a look at GM here. The initial situation is a 32-cent credit, okay, 32-cent credit. So let's do the math on this. 32-cent credit, that is our, I'm just going to abbreviate MG for max gain, okay? And remember, whenever I talk max gains and max losses, they're theoretical max gains and max losses. Let me just give you a situation here, just a slight tangent, but I think it's very important, okay? Let's say we have a stock, and I'm just going to jot down that 32 because I'm going to have to erase it here to get my little scratch pad off. Okay, let's say at expiration, so we have a 50 short call. I put minus C for short call. I have a long call at 51. Okay. And I've got two contracts here, but that doesn't matter. Let's say at expiration, this stock, or even before expiration, we get an early assignment on this stock, or at expiration, the stock goes a little bit above 40. It's between our strike prices. The stock goes to 50.5. This one's going to expire worthless. Okay. What happens to this one though? Okay. A short call. We are then short, in this case, because we have two contracts, 200 shares of stock. We're then short 200 shares of GM. Okay. And let's say the very next day, GM takes off and jumps up $10. Okay. GM jumps up $10. I'm short 200 shares. And so that'd be a $2,000 unrealized loss at that point on this trade. So in other words, when I say our theoretical max loss is such and such, that's the emphasis on that theoretical part, because there's been more than one trader, put it that way, in the past that have gone into these situations, and maybe they didn't close out like often we teach in this class, the short option before expiration, and they get assigned, and then the stock makes a big move and they get in a huge negative situation. Okay, they get in a huge negative situation. So there we go. That's my aside right now. Okay. Now, Kevin said, look, well, this is a bearish trade. Kevin's saying, well, we're getting bullish news on this. Now, admittedly, this is a short-term trade. Okay. This is a short-term trade. And yeah, that may change our longer-term outlook here. Certainly, today's jump in the stock was significant, has been significant. But in any case, let's go back to this. We said there was a 32, and I'm just going to do a per share basis. That's the initial credit. That means our loss is the max theoretical loss is $1 minus the 32, which is going to be what, 68 debit. Okay, that's our max loss. Keep in mind, any adjustments we make to this though is going to change the dynamic, maybe to the pro, maybe to the con side. Okay. There's a lot of different potential trades we could do, but let me just kind of discuss one potential one for you, and then we can talk about some of those. There's so many different possibilities. We talked earlier on the last one, we talked about 4 possibilities, and then I hadn't even thought about, I forgot who mentioned it, the possibility of just extending out the trade. That's a possibility as well. We could extend out this trade if we were still bearish on this and we wanted it to go. We could just roll this from 9 days out to whatever to extend that trade. Manuel said, could we can leg out of the short call. Just get out of the short call. Can we do that? Yeah, we could just buy back this short call right now. The current mark price is 96 cents. Okay. There's two contracts, so I'm going to double that. So I'm going to say it's going to cost us $190 to get out. I'm not going to factor in commissions here. We're just kind of rounding here. Okay. That's fine. We can do that. If we do that, then we're left with two long calls. Okay. Two long. Great. If I just turned super bullish on this trade, then that is what one possibility. What are our pros and cons? Remember, our initial credit on this trade was 32 cents. I'll do two contracts here. It was 32 times 2 is 64. $64 credit was our initial transaction. If we were to do that roll, if we were to just get out of the short position, that would be a 190 debit. Okay, that's supposed to be DB. That puts us in a that would put us in a situation of 124 into the trade at this point. And now, of course, we could always look to sell at this point, but we're not looking to sell. We're looking for it to go up. What's the worst at this point this could go down to? Well, this could go down to 0 at this point, right? This could end up out of the money. Or if GM goes way up, the upside is potentially unlimited. Of course, we only have 9 days to go till expiration, of course, and time decays starts working against us. In this current trade right now, we're actually positive theta, a little bit, not a ton. We're positive theta, 167, about $1.50 a day positive theta on that. That would turn that into a negative theta trade. Time decay would work against us there. So yeah, that's absolutely a possibility to do it that way if you turn real bullish on this. But we're not stuck to this. We could always just get out. We're basically break even right now. We could indeed look to shift this a little bit. Instead of this 51 short call vertical, we could change this. If we turn bullish, one approach is what we just went through, but another approach is we could shift this to a 51-52 long call vertical. Okay, that turns it from a bearish trade to a bullish trade. Now, to do so, what would we need to do? We would need to sell out of buy back our $50 call. Okay, mark price is 185, it's 85. I'm going to keep it in a one share contract, even though we have two contracts. Let's just talk about it. 85 cents per share. It would cost us to get out of that. We would then sell a $52 call. Well, how much is the $52 call going to cost us? Okay, so we'd be selling for 85. We'd be buying for 52. We'd be buying for 35. I think we said 85 minus 35, 50 cent debit per contract to shift that. Okay, 50 cent debit. So what are the consequences if we do that? Well, we're now in a debit transaction. Okay, the initial credit, we've spent more than that on this trade. And unless the stock moves up from here, the trade is going to, unless the stock moves up from here, then we'd be in a losing position on that trade. Furthermore, just like before, we would be shifting this from a positive theta trade to a negative theta trade. And one way to think of that is this. with theta, time decay, we have, right now, we have a $50 short contract. We have a $50 short contract. That is a positive theta trade. Positive theta trade. We have a long $51 contract. That's a negative theta trade. Why is this? So do they just offset each other? No. The one that's going to dominate typically is going to be the one that's closest to being at the money. Right now, the stock is closer to this one. So it's a positive theta trade. Time decay helps us out. But if we get rid of this one and shift this to a 52 short, that's our positive theta contract. Our stock is now going to be closer to our negative theta contract. So we could be shifting it to this to negative theta in that case. Okay. So there's lots of consequences here on these trades as we do these. You can adjust prices. You can roll these to different strike prices if you like, to try and help protect you, but it's going to cost you typically when you do that. You can roll them out in time, and that gives that trade more time to work in your favor, but typically that will be a debit transaction that's going to cost you to do so. You can just close out where we're at. Take our lumps, so to speak. In this case, we're about break even, so it's not even an issue. But also remember this. We've got under 10 days to go to expiration. Look back at your charts would be my suggestion for you. If you're comfortable with technical analysis, consider your charts here. And in this case, we're bearish. Are we shifting bullish? I don't know. I mean, today's candle, we're actually kind of closer to the bottom end of the candle, but it's still a 5% jump today, 4.8% jump today. So that may be enough, especially with 9 days to go in this, just to say, you know what, I'm going to get out for what I can, maybe just a few bucks, and I want to take that risk off that trade. Because remember, on a short call vertical or a short put vertical, we potentially stand to lose more than we potentially stand to gain when we do them out of the money, which is what we did. Our reward to risk is we're risking more than we stand to gain. So if we get to this kind of iffy situation, normally we're just going to look to close them out, especially if we're 10 days or less to go till expiration. So I'm going to buy that back, and I'm going to go and we'll see if we can get out here and confirm and send that trade. Okay. So I want to talk about one thing, and then I want to sum up here. The one thing is this. I just want to mention, we have a bunch of different trades in here, and we'll get back to managing more of them next week. I do have in our hedges, we put in, was this last week? We put in that XSP hedge. This is a hedge on the whole portfolio. Well, what happened over the last week? The market dropped over the last week. So I'm not going to say we got lucky, because the rest of the portfolio got hurt over the last week. But this hedge, this is why hedges are in there. They can help protect you on those losses right there. That's that XSP hedge that we did. If you're interested, look back at last week's session. You can look at the playlist here. Let me summarize. Sometimes you'll hear comments about fixing trades. I tried to give you a few different scenarios here of fixing trades, and sometimes they may make sense. I don't like that term fixing, though, because it implies things that aren't there. Any new trade you do, any correction or adjustment is going to bring on new risks. Maybe that risk is absolutely worth it. Maybe it's not worth it. You have to make that on a case-by-case basis. I can't make a blanket statement on anything, but consider your time frames of your trades. Consider not just your initial max loss, max gain, but any additional risks that you're adding to the trade. Not just additional debits you bring in, but if your spread becomes wider, that may imply a bigger potential risk if the trade goes against you. Okay, everybody, thanks for helping me. Thank you, Mr. Fairborn, for helping me out in the chat. Make sure you follow Mike on Twitter and myself as well, at Brent Moores CS, at Mike Fairborn CS. Those are our X handles. And we will see you all same time next week. Coming up next, trading price patterns. Have a great day, everybody. Bye-bye.